Hello, everyone, and welcome to the webinar. We're just going to take about 30 seconds to a minute to let everyone filter in, but you are in the right place. Welcome to the LSL Capital Assets Crash Course webinar. Hello, everybody. As you're filtering in, we're just waiting for everyone to kind of get on, a couple minutes, and then we'll get started. All right. How is everybody doing? Hello, everyone, and welcome to our next webinar in the Back to Basics series, Capital Assets Crash Course. We're so happy to have you here with us today. Before I introduce our presenters, I wanted to go over a couple of housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to the recording, as well as a copy of the slides and the other resources. So you will get a copy of the slides via email today. This webinar will only run for 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speakers, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or bottom of your screen and a toolbar will pop up. Also note that during this presentation, partner Ryan Domino will be typing back the answers to your questions. So if they come in through the Q&A box, he will be typing your answers back. This webinar is eligible for 1 hour of CPE credit. We will launch 4 polls throughout the presentation. To receive credit, you must answer 3 of the 4 polling questions. And you're also going to need to complete a short evaluation you will receive after the webinar. If you're having trouble seeing the polls, try minimizing the Zoom screen, as sometimes the poll questions pop up behind that. If you are using multiple screens, check each screen as it may pop up on the other screen. Now I'd like to introduce our presenters. Noah Daniels is a director in LSL's Consulting and Advisory Department, holding dual certifications as a CPA and CPFO, Certified Public Finance Officer. After an earlier tenure at LSL, Noah is thrilled to return, bringing a wealth of experience and a fresh perspective to the team. Specializing in local government finance and accounting, on top of his many years of audit experience, he brings nearly 9 years of experience from a government finance office where he advanced to the role of finance director. His hands-on approach and deep understanding of municipal finance challenges enable him to deliver impactful, actionable insights to the clients and effectively address complex technical issues and practical solutions to enhance financial operations. James Butera is a senior manager at LSL in the Insurance and Advisory Department. James arrived with LSL about 2.5 years ago, bringing with him a total of approximately 8 years of experience as both a finance director as a government finance officer and audit manager in the public accounting realm. His experience on both internal and external side of government accounting allows him to concurrently manage his team's audits effectively while also lending valuable insight and guidance to his clients, utilizing firsthand experience. With a comprehensive understanding of government auditing requirements and financial reporting, James brings practical solutions to his clients, helping them navigate the complexities and ever-changing industry of public sector finance. And behind the scenes is Ryan Domino, partner in LSL's Assurance and Advisory. Like I said before, he will be behind the scenes answering your questions through the Q&A, so feel free to put your questions in the Q&A box throughout the presentation. Okay, Noah and James, take it away.
Hey, thanks, Cami. Hey, everyone. We're glad to have you here today. We're going to cover a few topics today. Now, for capital assets, we all know there's just a lot going on. So what we tried to do today is summarize them into kind of the basic topics of additions, depreciation, disposals, the financial reporting, and some conclusions and some best practices that I'll probably share mostly from my experience, and James will share some things he's seen on the audit side. Again, we're kind of covering a high level here. We're going to try to give you some examples and cover some detail, but there's just a lot for capital assets. So as a starting point, let's kind of get the foundation set on what capital assets are, just in case anyone's a little confused about why they're here and why they're looking at this. I know some of you might just be going for some CPE credit right now. So definition for capital assets is it's any long-term assets used in operations with a useful life extending beyond 1 year. The two key terms here, operations and beyond 1 year. You know, we're not going to be looking for things that you're buying as investment. We're going to not be looking for things that are just, something you're going to use for the 1 year and that's it, because there's going to be no depreciation. So some common examples are buildings, infrastructure, land, equipment, and intangible assets is a new one that's come over the last few years, especially with subscription assets for software. So for an analogy, just real world example here, think of capital assets as you would like a big ticket purchase that you would make on your own. It's something like your house or your car. So imagine you buy your car. That car is not something that you're just going to use for a short while. It's a long-term investment on your behalf. And just like the purchase of an equipment, buildings, machinery, something that the government's going to use for many years. Also, again, that distinction between purchases for operations versus investments. So if you buy two land parcels, if you're buying one to be used for an operation, maybe for like a library or to build a road or some infrastructure on, that's going to be different than your land that you bought generally for resale. You're going to classify it different on the balance sheets. You're not going to be depreciating that land you purchased for resale, just the land that you purchased for operations. So we won't get into too much of this because we're going to focus on the accounting side, but another thing to keep in mind is that capital asset management is really important for financial stability, decision making, and just overall your compliance and audit readiness. There's a lot of federal and state requirements when you use those fundings to purchase capital assets that you want to keep track of those. But also from a financial stability and decision making standpoint, if you do have proper accounting setup, you're able to get that information from your financials and really look at, is that asset being depreciated correctly? Are we spending a lot more on maintenance than we would normally expect? Those things are going to help you out with your budget long term and really help predict your future needs. We won't go into this too much, but these are just some of the major classifications of capital asset. And we have CIP, which is going to be your assets in progress, not yet placed in service, and your land, which is a set. You want to always separate this from your buildings and also make sure you're including things like land for reparation costs. Those two are not depreciated versus your other types of capital assets that are depreciated. You have buildings, which are permanent non-movable structures. You have your improvements other than buildings, which are things like fences, parking lots, things that are going to be kind of adjacent to your buildings. And then you have your furnishing and equipment, movable assets primarily, things that you probably want to track and have some inventory controls over. But this also could include vehicles. And then you got your infrastructure. That's your long-lived assets, typically reported as like a network, like for example, roads or some other type of subsystem. So kind of moving on with this foundational is what do you want to capitalize? Well, you're going to have your tangible, your buildings, your infrastructure, and your intangible, like your leases and subscriptions. And if you decide to start looking at the capitalization, again, 1 year of useful life, and then the capital asset policy, everyone should have one. That's going to ensure that you're handling capital assets consistently and you're applying cost thresholds and the useful lives accurately for all the different things that you purchase. Sorry, it's distracting. There we go. So why is that cost thresholds, which we're going to touch on a little bit more, why is that so important? Well, $5,000 is probably the common general one that I've seen a lot, but I also have seen a lot where your infrastructure is not going to be 5,000. It may be a lot higher. And so why that's important is you just want to have it consistently applied through everything. You do not want to add too much to your capital asset register. It's just going to make it really tedious to tack, and adding too much over time, really, especially as you get down the road, makes it really hard to find disposals and things that need to be taken off. And so that actually brings us to our first polling question. So I'm really curious. What are the cost thresholds that you use for capitalization? Is it $1,000, which is maybe something I would expect for smaller governments out there? 5,000, which was that minimum threshold that the GFOA applied? Do you have higher thresholds for things like infrastructure, like those big projects that the city builds? If you're spending $100,000 for a road versus purchasing a $30,000 car, those might have different thresholds. Or does it vary depending on the capital asset? Like, are they all over the place? I'm really curious to know what everyone else is doing. When I was at City of Rancho Cucamonga, we had this common $5,000 threshold, and we kind of explored changing that. And what we did for that is just really evaluated if we changed it, how many assets would fall off from the register, and what also would it do to our balance sheet? Would it take a lot of assets off, like from a percentage standpoint? So really curious to hear about that.
All right, thanks, Noah. So, from an audit perspective, we wanted to kind of go over some of the common things we see from a capitalization policy perspective, some common, sometimes errors, sometimes just kind of best practices that we've seen, especially recently. So the first one, a little bit, kind of a gray area, but as Noah kind of touched on, when it comes to capitalizing, a group of assets. For example, if you're purchasing radios in bulk and the use of those assets are not necessarily going to be connected to each other, kind of keep in mind when it comes to disposing of maybe one, two, or three of those assets, it's going to be kind of impractical to kind of go through and estimate how to dispose of a piece of that group that you capitalize. So in that instance, it may be best to just expense those radios in that case, since individually they're obviously going to be below your capitalization threshold. Another common one we'll see, especially kind of when it comes to CIP, is there could be some feasibility studies and other ineligible expenditures or expenses kind of grouped into that CIP balance. Noah will kind of touch on some of those ineligible expenses in a couple slides, but feasibility studies is a common one that we have seen, especially recently. Another good thing to do, especially for your fund level statements, take a look at your total capital outlay in your governmental fund GL, and compare that to the total additions that you're providing to your auditor. We'll expect from our perspective to the capital outlay in that group, most likely is going to be more than the total additions provided. There's going to be things in that account group that are below your threshold or are ineligible to be capitalized, but there really shouldn't be any significant discrepancies between the total additions you're providing and the total expenditures sitting in that capital outlay grouping. Also, keep in mind, if you're ordering goods in June and those items don't come in by the end of the year, those would not be included as an addition. Those would roll forward, be treated kind of as an encumbrance and kind of roll that PO listing open to the next year. We've had scenarios where some of those cities and other agencies that are purchasing those items that haven't yet been received are actually including those as current year additions, so we have to back those out. Especially during COVID when vehicles and there were huge shortages of inventory throughout the nation. A lot of these vehicles sometimes took a year, even 2 years to come in. So sometimes those were kind of sitting out there for a while before they were actually capitalized. And lastly, just a few kind of informal policy recommendations that we'll typically give to some of our clients is updating some of those policies to include verbiage for 87 and 96. So now that there are, kind of the right to use lease and right to use subscription assets on your financial statements, a lot of cities haven't yet really updated the verbiage in the policy to include whether there's a threshold for those assets. So that's just kind of a good thing to keep in mind if you haven't done that yet. Another one, we're kind of recommending to our clients is just to be a little cautious when it comes to applying that threshold to, say, the long-term debt piece of 87 and 96. Obviously the capital asset piece of that transaction will have a threshold. But if you're foregoing capitalizing, 3, 4, 5 leases because they're individually underneath your threshold, the cumulative impact of those from a liability standpoint could elevate themselves to an audit entry or adjustment, since the long-term debt piece wouldn't have a threshold associated with it. And lastly, just updating verbiage and thresholds to mirror your statements. Typically, in the footnote, there could be an excerpt for different useful lives or different thresholds that are used. So just kind of make sure those two are in alignment, and kind of just wrapping up some of those informal recommendations.
Perfect. Thanks, James. So one of the things I was doing, polling just popped up. Okay, so like I expected, yeah, about 64% of all the people that voted still use the $5,000 threshold. Just kind of a comment. We might get into this later a little bit, but looking at that $5,000 threshold and really saying, does this fit? That would probably be something really good to do after the audit season, to look at and make sure that it really aligns with the business. Now, of course, caveat, want to make sure it's updated in your capital asset policy, but we also want to make sure that that would comply with federal. So you want to always add that nuance of, if purchased with grant dollars, that those would be evaluated separately, but those would be the exception to kind of doing an overhaul of those capitalization thresholds. Really good stuff. Thank you, guys. So one of the things I was trying to give to the group here is maybe something different than what you've normally seen. So what I did here is I wrote down what I would generally apply as the steps in the acquisition process. I know on the functional side, on the doing this every single year, sometimes it's good to look at the process and really evaluate where you can start finding information if you're having problems or needing more information on setting up for doing those additions every single year. So we start off with the process of acquiring capital asset. Typically starts with a department request. Often this is during the annual budget process, but I also could see it during the year due to unforeseen needs, like if you need to buy a new capital project comes up, or you need to buy some new equipment during the year, you come up there. But just because it's initial request doesn't mean it's actually happening yet. It's just something to keep an eye out for. And then the request typically goes through a budget review and approval to ensure that it fits within the capital improvement budget. And often these are recorded with the capital outlay accounts, or at least budgeted there. Relevant documents, again, to look at to find all of these capital purchases and capital projects would be your annual budget and maybe even your city council minutes. If your annual budget, it should include your construction improvement projects, lots of CIP acronyms out there. So you can start looking through there. And then after approval, generally a purchase order is created to track the asset requisition. And actually that purchase requisition may also be a good additional piece of information on the capital projects. You might be able to find information such as the staff reports, bids, or other relevant documents to get more information when you're putting together your schedules at the end of the year. Accounting records, this is where you've done the whole year. We'll talk about this later. Spoiler alert, be a polling question later, but when do you update? Regularly updating is always recommended to avoid a year-end crunch. But if you are doing the year-end crunch right now, going through and looking for these documents, that's going to help you set up for your accounting of everything. And lastly, once you accumulate all your costs, you know what should be registered, you're going to start depreciation to track that asset's value reduction over time. Most of the time, this is going to be automated by your accounting system. But if you are using an Excel sheet, you do want to avoid some errors with, basically the ones I've seen is it can over depreciate where you're going to be looking for negative balances, or you just have a formula error where it's not depreciating correctly, or it could get a little complicated if you're doing like depreciation as of the month it gets put in, like if you did the wrong proration for the first year. We'll talk about that a little bit later on, maybe some practices to look for. And then, of course, there's that periodic review that needs to be conducted for the assets. You're looking for those improvements that are beyond just the normal routine improvements and, repairs and maintenance. You're actually looking for improvements that will increase the utility of that asset you placed into service. This could also start being an indication that the asset's no longer needed, and then you should probably be talking to your purchasing department that might be handling disposals, or maybe it's a different department, or maybe it's the departments themselves on identifying those assets that are no longer in use, were disposed that you were not aware of, and then removing them from your accounting records. So what should we capitalize? Well, obviously the direct costs, the purchase price, the costs for acquiring it. If you have extensive legal fees, land preparation fees, these are kind of the common examples in the GFOA. So anything direct. You're also going to have those ancillary costs, transportation costs, installation costs. If there's insurance during delivery, those are going to be included for certain. The thing that I always want to keep in mind is where are all these costs recorded though on your GL? Are they all put into a capital outlay account? Are they spread out? Do you have job ledgers to track everything? These are going to be really important tools that you're going to need to know within your group on how to find all those costs. And then briefly just want to touch on what should not be capitalized. Feasibility studies, that's a common one. But in fact, it's any cost that you are incurring before it's probable that you're going to get that asset. So if you're doing any sorts of studies or reviewing the costs of anything, do not include those. Not until that asset's kind of underway and you know you're going to be capitalizing it. Training costs is also another little tricky one. You generally want to exclude these. An example that I would give you from a real world scenario is if you buy a vehicle that requires a Class A driver's license, well, you wouldn't include any of that Class A driver's training because that's not to get the asset ready for use. That's going to get your employees ready to be able to use the asset. So generally, training costs, you do not want to capitalize those. And then interest costs. I actually heard about this from somebody that we don't do capitalized interest anymore. Most of us should know that, but just in case you don't include the interest, that cost of financing is not really a part of the asset's value. So from a record keeping standpoint, make sure when you're putting everything together at the end of the year, you keep really detailed records of where your costs are coming from. That will really help too if you have kind of costs spread all over or you don't have a really good job ledger to track with. And then again, regularly reviewing the costs will really save you a lot of time. Maybe you can't do it this time around, but going forward, I'd really recommend regular reviews of your capital costs so you can kind of ease some of that pain that we're kind of feeling at the end of the year.
All right, so just to kind of put quick, basic visual together of kind of how a common transaction for purchase of equipment would be handled. So you can see, so city or agency purchases a piece of equipment for 50,000, and then there's a listing of other common costs that are associated with placing an asset in service, including the training there for 1,000. So you can see that the total cost to the city is 56,500, but the total historical cost, which is what would be included, from a governmental fund perspective, if you're providing the asset addition listing to your auditors, the amount that you would put on your listing would be the 55.5, which would exclude that $1,000 training cost. So kind of piggybacking off what we touched on a couple slides ago, where from an auditor perspective, we would expect that capital outlay GL total to be higher than your addition listing, because you can see here from the journal entry, that full amount of the asset is still hitting the capital outlay grouping. So you're still showing that expenditure from a governmental fund level. And then when it comes to the full accrual conversion entry here, or if it's in an enterprise fund, just recording it in that fund, we would debit the asset for the historical cost amount, and then remove obviously that capital outlay expenditure from the fund level. And if this is a water fund or a sewer fund, that capital outlay credit could be cash or could be any sort of liability, depending on when the money is actually being paid. That just kind of puts a little visual on kind of how that's commonly accounted for.
Right. So Moving on, another big piece of the capital asset equation for many cities, at least, is donated infrastructure. So generally, or not generally, the rule is acquisition value. So the acquisition value is going to be the price that you would pay for that asset at the date of donation. Now, that's where it gets a little bit complicated. It's going to slightly depend on what information you have available, but let's kind of play through this. So donating infrastructure, the common thing here is infrastructure for roads, bridges, sewers, culverts, those types of things. They're typically provided at no cost from the developer when they're finished with their project to the city. Granted, I have heard, I have not dealt with a few that have like a nominal monetary exchange of like $1, in which case treat it like it's donated anyway. The price of that infrastructure was definitely not $1, and you're still going to want to use that acquisition cost. So donated infrastructure can be valued in a few ways. You can get an appraisal. You can use engineering estimates, and talking to your engineering department, they could probably come up with at least their cost, which they put together for their capital projects, on a metric of like square yardage, square footage, cubic feet, whatever the applicable measurement is there. Or you could also take developers' costs. Something else that I've used in the past would be like bonding documents, basically the amount of performance bond that the city might require the developer to go out and get. Just in case they kind of pick up and head out of town and don't finish the project, that's what you would cash out to be able to build that stuff by yourself. Once the acquisition value is set, that donated infrastructure gets capitalized like every other purchase asset you would normally do. And that depreciation start date would be the donation date typically, and then you apply that same useful life. So what's important here? Well, proper documentation, right? So when James's crew comes out and they start asking about this donated infrastructure, it is not uncommon, at least I've had it, to actually have to provide some of that information. Like, how did you actually value this, Noah? So the things that we would provide were city council action, if you have it, of actually accepting that donated infrastructure. Developer agreements possibly might also work here if you don't have to actually have official acceptance by your city council. And the developer agreement might actually specify that that infrastructure and everything with it is going to become public and not be held and be private at the end of the day. And then also whatever I use. So typically the bonding document, the actual cost that we got from the developer, those is what would be included.
Yep. So just to kind of do another quick kind of visual here, like Noah mentioned, really common scenario that we come across from our side. So in this instance, we have donated infrastructure to a city, say for $500,000. Again, just to piggyback, if there's no readily determinable market value, like Noah mentioned, an auditor will typically not push back at all if it's developers cost, really kind of any way to support a reasonable estimate for the value that you're putting on it will typically suffice. But in this instance, there's no modified accrual impact. There's no cash, kind of cash, that short-term cash basis going on. It's strictly all in the full accrual. So whether it's for a governmental fund infrastructure, be part of your GASB 34 entries, or again, if it's like a water sewer infrastructure, it gets obviously capitalized right in the full accrual fund itself. So then, yeah, switching gears kind of to how some of those additions will actually be audited most commonly. So from an auditor perspective, it's going to be very common to have those broken up between depreciable and non-depreciable assets. So it's not going to typically be selected based on here's your total vehicles, here's your total equipment, and so on and so forth. So usually the testing will line up with how the ACFR is presented. So on your statement of net position, you'll most commonly have your depreciable net line, and then you'll have your non-depreciable line. So the opinion unit that the auditors will opine on in the audit report, the testing will sort of line up to match that. So really kind of the main documentation that will be needed is, copies of checks, invoices, and receiving documentation are usually what an auditor will request. And just to kind of go, pick it back again off what we touched on earlier, the receiving documentation sometimes is not always thought to be maintained from the city side. So kind of when that was one of the main components we made sure to retain, when I was finance director, is just to make sure to have all of the, support for when the item was received. Because again, if it wasn't received by 6:30, it would not be on your addition listing at the end of the year. And again, sometimes, especially if there's a lot of construction progress projects going on, maybe there's just a lot of equipment purchase. Sometimes, uploading or providing support for those items can be overwhelming. A really good thing that some of the cities we work with do is, sometimes quarterly they'll scan through all their GL and their purchases and sort of just scan all the support onto a network drive, and just so everything's ready. So when it comes time to do the audit, they'll just sort of mass upload supporting documentation, and we can kind of just find the items that way. And it really, reduces some of the legwork and requests and emails going back and forth. Then from the full accrual and the enterprise fund perspective, since obviously those CIP projects are capitalized in the fund directly, it's not always feasible from an audit perspective to kind of pull those individual project expenses from the CIP balance sheet GL detail. So just kind of making sure that you have a listing of project expenses that have been capitalized in those funds ready, because most commonly the auditor will probably sample individual expenses. Might not always be project by project. They might just kind of take the entire listing for all projects and just sample the detail that way. So always a good thing, especially for your water fund, sewer funds, kind of have a separate expense project detail ready for them.
All right. So air quotes here, best practices for additions. So these are not official best practices, but I guess you can call these NOAA's best practices. These are the things that we would probably want to, implement before the year-end crunch. But these are nonetheless the best practices as I see them from actually doing this for several years. So first, I've said it a few times if you count on, perform the regular audits to verify the assets are properly capitalized. Review that capitalized asset register for movable assets, close and make sure that everything is there. Do an inventory probably close to the balance sheet date to have the most accurate records and really review that. But also that regular review should involve actually adding assets to your register. So things that we would do at the City of Rancho Cucamonga is when we bought that asset that needed to be registered right away, like that vehicle, we would register it right there. So that at least at the end of the year, we could review those costs, make sure we didn't miss anything ancillary. But also capital projects, we would at least twice a year review all the completed projects or what we knew what was completed and get all the information together to actually value that asset. Just doing it, basically middle of the year, more towards like February, March, because of the budget cycle, and then at the end of the year, greatly helped our efficiency and effectiveness in getting this done. Cross-department collaboration. So maintaining really strong communication between finance, purchasing, and the operation departments is critical. You can provide better staff training on how to manage and document asset additions correctly, ensure that all the direct costs and ancillary costs are captured together. Basically all those pain points that, you working late at night trying to get all the costs together, those are the things you want to write down and then circle back with those departments to talk about getting better information to you as the accountant. Those are going to really help you out. And then accurate and timely recording. I brought this up, but if you can register additions as soon as they're acquired and put in and place them into service, you'll avoid that year-end backlog. And then capitalizing large-scale projects. So one of the things that is probably really helpful, especially later on when we talk about disposals, is for large or complex projects, capitalize them in phases or the categories like land, buildings, improvements within buildings, so you can track those assets by their different useful lives. This is going to help you manage partial disposals down the road or handle improvements to ensure accurate financial reporting. But what I think is probably most apt, and we're going to find out here in a minute, is those last minute practices and dishes. Or if you just have a really lean accounting department, these are kind of those basic tasks that you should be doing. Prioritize your key tasks, meaning use your capitalization thresholds, whatever they are, 5,000 being the one for most of us, and filter out those capital projects that are below those thresholds. But just be a little mindful. The caveat here is that you may have multi-year projects that may exceed your thresholds over time. So just because it isn't over that threshold now doesn't mean it won't be. And if you do not capture those in your CIP, you're going to miss out on some costs in the beginning. And review your budget documentation for that. That's going to be really helpful because if you see, a few $1,000s in year one, but that's going to be $1 million project, well, you can be certain in those subsequent years you're going to have more costs being added to it. Also, look at your chart of accounts and really you should be able to distinguish your capital versus operating expenditures. Or if you don't do that, use a job ledger. Or what we would also do is we had our job ledger specific for capital projects. We would use purchase orders to help identify the groups of those assets. You have to figure there's gonna be one purchase order, maybe a few, but most time one, just for that one purchase. And you can kind of group things together like that and evaluate them. To James's point, gather your essential documentation. You collect purchase orders, your invoice, and any other documentation that you use to confirm the assets are in service and that you have the right accounting for them. It's going to go a long way when James's crew comes out and they start having questions. You can kind of just hand that right over and say, here you go. And to the point about donating infrastructure, especially when you're doing those valuations where they're kind of an estimate in a sense, you want to keep really good records of those. And then ultimately, focus on the audit and compliance readiness. Ensure that you're following your capitalization thresholds. Follow any federal or state grant compliance requirements. Document every decision to support the balances that you have for the audit process. And that way you can also review and double check entries to ensure they're accurate between your schedules and your GL. And if you did any sort of adjustments, you can document those too. The main point about this is stopping any potential issues down the road where you give a schedule over to James and it's different than what's in your GL, vice versa. It's just going to cause you more work and kind of raise the alarm bells a little bit about how accurate those schedules are going to be. So polling question 2, what's the frequency that you currently work on capital assets? Do you do it monthly? Extra credit if you do. I'm not even sure if that's really necessary, but I know there are some people out there that do. Quarterly, periodically for completed capital projects, maybe, sporadically throughout the year when it makes sense, or do you just kind of wait until the end of the year? There are no wrong answers. We just kind of want to get a sense from the group and, might just be commiserating with everyone else that we save most of this until the very end. All right. So we've moved on from additions. That was going to be 90% of our presentation. We're kind of getting into the home stretch here. So depreciation, if anyone doesn't know, depreciation expense is just the spreading out of the cost of that capital asset over its useful life. Really, it's meant to reflect the asset's decreasing value. So useful life obviously is important here. Your salvage value, often though, I see it as 0 because typically, infrastructure, you're not really selling in the market, and those assets that you do sell maybe at auction don't really go for a lot. So it's not really uncommon to just have 0 for your salvage value. I'd be really curious, and I'd love if someone reached out to me if they said they use something else for salvage value. And then your depreciation start date. Typically, depreciation is best to start it when the asset is placed in service, like in the month. But another good practice is just to do either a full year in the first year or nothing in the first year, but just make sure you're consistent with that. For us as governments, we use straight line most of the time. There are some systems, or at least I think I've heard of other agencies doing things like activity based, but since we don't have any real income tax considerations, straight line method is going to be the most common and most practical for all of us. There's a lot of man hours that would have to go into tracking activity based or any other sort of method of depreciation. All right, James.
Awesome. Thanks, Noel. Looks like we did get our poll results. So it looks like, a little under half our end of the year, and a quarter are monthly. So monthly did take second place there. So that's definitely good to hear. Makes everybody's lives easier, come year end, come audit time. So that's awesome. So just to kind of a little bow on the depreciation component from an audit perspective, there's varying ways that different firms or auditors may test depreciation. Most common ones are going to be ratio analyses, recalculations, and just kind of that assessment of the useful life reasonableness and kind of the higher level approach to it. So just some, common points to have from a city perspective is just have that listing of your itemized assets ready. So, 99% of the time, this will be a system generated report. It's just your annual depreciation expense for the year by asset. So if the auditors do sample some assets and perform a recalculation on it, usually straight line, like Noah said, should be really straightforward to just, take the cost basis, divided by useful life, and the auditor should be able to recalculate however many they want, with little to no inquiry from our end, which I know is great to hear from the city side. Also kind of the one that slips through the cracks a lot is, review the fully depreciated assets you have as of year end. Try to break those assets out or find a report that you could. The reason for that is if we do perform any sort of ratio analysis, kind of taking it by category as a whole and sort of estimating the average useful life that is attributed to that account group based on your policy, we would want to back those fully depreciated assets out because they're in that cost basis pool on your ACFR, but they're not having depreciation applied to it. So just kind of make sure you could either your system maybe can alter a report parameter, run that, or you may have that already readily available. And then lastly, just perform some cursory reviews of your useful lives. Just make sure that there's no clerical errors or anything really out of whack on your schedule, and just make sure that everything kind of seems in line from a high level perspective to just avoid any further questions from us.
All right, so I didn't put in air quotes here, but what are depreciation best practices? I'm going to skip over kind of like the things I've already talked about, doing those regular reviews, doing those reconciliations. Again, if you're using Excel sheets, that's probably where you want to spend extra time looking at your depreciation schedules, making sure that you're not over depreciated at the end of the year. One of the questions that came up, and I'll try to address it in this slide, is because it really matters for depreciation, is, well, I don't have like an inventory of capital assets. What am I supposed to do? So what I would definitely recommend is moving forward as you bring on additions into your asset register that's probably being kept in Excel, is put some sort of locality or at least a department responsible for those assets. That's going to help you down the road because you're going to be able to at least go to those departments or go to where you believe the asset should be and do that inventory. And then if you have nothing and you need to start putting something together, well, it's probably a good time to start going backwards and actually going out and doing field studies about, well, what assets do I have in place? Are they on my register? Am I missing things? And start truing up your capital asset register. So at least from there on, you can keep really good track. So one of the last things on here is maintaining records. Talked about that a little bit just right now, but the other thing is if you ever make any adjustments to those schedules or adjustments within your system, it's always really good to keep those notes. So if you prospectively change your depreciation, if you have to make an adjustment because it was over depreciated, keep notes on those. Those are the things that typically come up and are going to be essential for your audit. So disposal process overview. Now, I don't know about you guys, but disposal was actually one of the harder things for us to handle. The additions we're capturing in the accounting. More often than not, you're dealing with assets that you purchased years, maybe even decades ago. So actually finding out if those were disposed, just from a normal process is going to be a little challenging depending on what record keeping was like in the past. But also, let's be honest, sometimes those disposal processes are not actually followed, and a department may just kind of more or less toss an asset, and then you're really like when you go and do that, and we're like, well, where are the tables and chairs that I thought I had? That's it's kind of the hard part to do. It's like you don't know what happens sometimes. So what are the general steps? So identify the assets. They may be no longer needed because they're obsolete, or they're no longer needed, or they're fully depreciated. Review those depreciation schedules, your capital asset inventory, city council action, disposition forms if you have them. Another good one is look at your invoices for auction or the cash receipts that come in. Sometimes those will identify what assets were sold there, and that may be a good record back to your capital asset registry to see what might need to be removed or at least look into. Always though, try to follow those processes that you have in place for authorization. We're not supposed to in government just be kind of willy-nilly getting rid of assets without having some form of proper documentation. And then lastly, get rid of that disposal off of your books and account for any gain or loss that might be necessary for it.
All right. And then, so from an audit perspective, just some of the most commonly requested supporting documentation that'll most likely come, to your desk or through email from us. Really from a CIP perspective, kind of retain those notice of completion approvals for projects that are completed. So on the capital asset roll forward that will show in a couple of slides, that would show as a transfer out, and then into one of the depreciable categories, most commonly infrastructure for those. Usually really easy for us to just look at a council resolution or council meeting minutes for that. So just maintaining the date that went to council is easy for us to kind of find that meeting date on the website and pull that support. Similar with surplus equipment designations, but kind of like Noah mentioned, it's everything, really should have an authorization component of it before it's sold. And from an audit perspective, we will inquire about the authorization piece. So just kind of, again, maybe marking a council meeting date for that. Really common to see kind of, even if it's, on consent, it just goes through and here's a listing of surplus equipment. And then, the city takes it to auction or scraps it or what have you. Auction sale approvals and receipts, copies of checks, receipt remittance, and deposit detail of when either the check or EFT transfer came through will suffice. And then from a gain loss perspective, just kind of maintain how that calculation is done. Whether it is a trade-in, it could kind of alter how that calculation is, how that calculation is calculated, but often not in a material difference. So really just kind of that, having support for that gain loss calculation for us to look at, materiality does come into play there. And then I think we have an example, really quick, kind of like a high level example of a disposal. So if a city has a vehicle for 25 grand and it reaches the end of its useful life, so it's fully depreciated in this instance, from the modified accrual standpoint, you would record the cash of 1,000 or whatever it went to auction for, record in that proceeds or sometimes miscellaneous revenue, or sale of asset revenue account. You show that revenue component, and then from the full accrual standpoint, you fully remove the accumulated depreciation and fully remove the vehicle from your listing.
All right, thanks, James. So our third polling question here, how often do you perform a review of capital asset records to identify any end of life or disposed assets? Every year, about every 3 years, about every 5 years, only if it seems necessary based on the stuff you found out. Other examples here, and I don't have them on here, is maybe you do a rotation and you kind of go through all the vehicles and then you go back and then the next year you do all the equipment. There's a lot of different ways you can go about doing this. We're just going to keep moving on for time here, and we'll read the polling question when it comes in. All right, so James, capital asset roll forward.
All right, so really important document here. I know it's a little small, but I think the slides are available. This is just kind of a common template that we'll see. Really good thing to maintain from a city perspective. and really just kind of make sure that everything, lines up and calculates correctly. Really quick things to look at here is, make sure that the beginning balance ties to your ACFR from last year. So really, tie those out to the statement net position. There could be, you know, things change during drafts, or if it's a city prepared ACFR, sometimes there could be discrepancies in the footnotes. But really make sure that the statement net position balances tie out to that beginning balance component. Then your additions are just obviously your new assets acquired or current year CIP, project expenses. Your disposals are the assets removed from service that we kind of touched on. And the transfer piece is really maintained for the CIP. So any sort of projects that are completed are a transfer out and then a transfer in to the coinciding depreciable bucket. So really important to kind of make sure that the transfer is net to zero at the bottom of your reconciliation. Also, it's good to put if you have a long-term account group on your GL for your governmental activities asset, make sure you include those balances or include any sort of report module balances that you have to kind of tie those balances out. It really kind of separating them by city, or if you have internal service funds, breaking those pieces out on this roll forward will definitely help from an audit perspective in terms of testing populations and things like that. So the next slide is same roll forward, but just the accumulated depreciation component towards the bottom. So treat it the same exact way. But the main thing that we'll see, and a lot of times if it's kind of like Noah touched on earlier, if it's a manual Excel calculation, it's pretty common that the formula might over depreciate the asset. In this column for your depreciation, it's really important just to check that you're not removing more depreciation than the cost basis that you're removing. Also, there are times where we'll see disposals in the cost basis up top, and then there's no coinciding depreciation showing as a deletion at the bottom of this roll forward. So really just kind of doing a quick check and kind of, make sure there's no variances, making sure everything looks good. And if you're able to kind of put something like this together, it's really a snippet of your footnote for the most part from your ACFR. Really goes a long way to make the audit more efficient. And then lastly, just a real simple, CIP roll forward example. So obviously, for really larger cities, there's going to be a high volume of capital projects. So it doesn't necessarily have to be a manual Excel sheet that you're putting together and tracking, but there should be a way to break out each project to show the beginning balance, which would tie to your prior year ACFR CIP total. You'd have additions, which would be any sort of current year project expense or expenditure, depending on where the project is reported. And then your deletions or transfers would be any sort of completed project. So really this just kind of helps, if there's, hundreds of projects that are ongoing, sometimes there could be outdated ones that maybe have just sort of slipped through the cracks. So by kind of doing this every year and checking them by project, it's good to kind of have that little check figure for whether it's ongoing or not, just to make sure that your CIP balances are current, they're up to date, and nothing is kind of slipping through the cracks.
One thing I would add too is look at your depreciation, your additions for CIP, your listing. If you don't see any additions, that may be something you want to look at to see if it was maybe an abandoned project or if it's just on hold. Again, if there's no chance that it's going to be actually capitalized, like you may have spent some of those costs and then it's determined that you're not going to be pursuing the asset, you want to get that off of your CIP and not place that into service. So last polling question here, and while I'll read this polling question, then I'll kind of give the results of the last one. Is what do you find to be the hardest part of managing a capital asset? Is it recording the asset additions? Is it the identifying the disposals? Or is it calculating depreciation? Or just honestly managing everything at once? And then from the last polling question is, I'm actually really surprised about this. There's every year is when people start looking at their listings to see if they've had any assets that might need to be disposed. That's really good. All right, we'll keep moving on for time. Just again, why is this important is typically for most governments, at least, capital assets are going to be the biggest asset class. And so from a display and disclosure standpoint, it's really important we get this stuff right. So for the example here, thank you, City of Brea. 66% of total assets is what makes up their uh, is what capital asset comprises of. That's a pretty big number. Again, thinking back to the financial important and decision-making importance, knowing what these balances are and making sure that they're accurate is going to lead to better decision-making and planned use of monies down the road. And then on the notes and disclosure, the thing that I want to point out here is we want to definitely separate those assets that are not being depreciated from those assets that are being depreciated. And then a note on intangible assets is, especially with the inclusion of leases and subscriptions, you want to separate those so that they're meaningful. So like in this example, I loved it, was equipment, and then you have right to use for equipment. So basically they have equipment that they purchased versus equipment that I'm presuming that they're leasing. You do want to separate those. You also don't want to show just one intangible line unless it absolutely makes sense. Like if you have a bunch of different varieties of intangible assets, you don't want to show this as one line. You want to separate them out for proper transparency and disclosure of those capital assets. It's really important to really think about from a significant point. You want groups of those major classes of assets to be meaningful and make sense. And lastly, it's just some final tips and resources. A lot of the information that James and I got here is from the GFOA. So a few little readings if you want to do them. There's also a book available for purchase. I have not read the book, but I know we purchased it at the City of Rancho Cucamonga, and from what I heard, it was very helpful. And with that, I think we're really close to time, but are there any questions? All right. So the next webinar in the Back to Basics series is going to be for grants from A to Z. It's going to be on Tuesday, September 24th at 1:30 p.m. Pacific Standard Time. The link to the to register for it is going to be in the chat, and you will also be sent. We'll also be sending out an email for registration. Thank you guys so much. I know we were cutting short on time. Capital assets is big, like we said. There's a lot of aspects to it. If there's anything that we can help with, please email me or James. We are always happy to help, and good luck out there. Thanks, everyone.
Thank you all.